back to Trading 360. I'm Nicole Petalides, live on the floor of the New York Stock Exchange. A spotlight on Deere. The company came out with its quarterly numbers and guidance was a little bit weak and put some pressure on the stock. But now what? Jonathan Sacreta is with us, equity research analyst at CFRA. Thank you so much for being with us. You have a hold rating, a 390 target. Tell me some thoughts on Deere. We'll get into the whole agricultural picture too, and maybe some of the other players, but it did have a decent quarter, right?
Exactly. Good morning. I'm glad to be here. So yeah, it wasn't a bad quarter looking at it in isolation. So a beat on both earnings and sales, but as you mentioned, the outlook is really what just was a negative for investors, right? This was the second consecutive cut to guidance stemming from the initial guidance in November of last year. So understandably, investors aren't too thrilled about that. We've seen profit outlook be reduced each time. And a lot of this is really driven by just the broader macro environment stemming around agricultural prices, right? Everything is flowing from farmer income levels. And as we've seen crop prices in a very uninterrupted fashion decline, we've also correspondingly seen that outlook kind of wither as well. So I think Deere is kind of taking a more conservative approach as far as their outlook. And we think this is appropriate. Our hold rating heading into this quarter, we felt like right now valuation kind of supports a murkier outlook. Our price target was a bit more conservative than the broader street at 395. We cut to 390, which is right now right around where Deere is trading. So we think currently it's near fair value. We think some of that negative sentiment is priced in. But of course, based on agricultural prices and inventory levels, we think we could either go both ways moving through the rest of the year.
I'll tell you, you are more conservative than much of the street because today, just this morning, Stifel, D.A. Davidson, OPCO, Deutsche Bank, Baird, and Stifel, I said earlier, Daiwa Securities all have targets that are over $400. What is it that maybe they're looking at that you think they should be a little more conservative on?
I think if just the momentum and how steep this decline has been in crop prices, right? So if we look at corn, if we look at wheat, if we look at soybean prices, they have yet to stabilize. So across the board, these have declined 20 to 30% just in the past year alone, and now they're trading more in line with what we saw in the later portion of 2020. So this is not going to bode well for farmer incomes. Right now, the USDA is forecasting a decline of 26% in farmer incomes to around 116 billion in the U.S. So really, this is coming off a very high level that we've seen over the past 2 years. So I think there's just a lot of risk. Partly, I think another factor here is interest rates. A lot of the, especially the more profitable items that Deere sells, these are financed. So I think there is a risk if we don't see as many interest rates cuts as we're expecting in the later half of this year, or even going into next year, that this could be another downside catalyst. So we do think there are some risks. And currently right now, the valuation isn't exactly at a steep discount relative to historical averages. So we're not really seeing the valuation support these higher risks. So that kind of backs our hold rating currently.
Yeah. I just said exactly that in my last conversation when we were talking about Caterpillar, and I was saying higher for longer rates, or maybe in event they go higher in case, the Fed goes rogue and does that hike that maybe some are speaking of. But you talked about some of the finance products that Deere puts out there, and in a high rate environment, what products are those that could come under some, pressure going forward because rates haven't budged too much lately?
Right. So the higher priced items like large tractors, mostly equipment and machinery tied to the large ag business. And we saw in the most recent quarter in the profitability was impacted quite a bit by volume declines, but more specifically mix. So the more profitable items that are typically sold at higher values were declining faster than some of the more affordable low-hanging fruit equipment. So this is a part of the concerns we have going into the second half of the year with profitability, as the more profitable equipment is going to be harder to finance. So we think that, like we said, if interest rates don't start moderating sooner than expected, then the profitability, not just in sales, but profitability is going to take quite a hit.
Yeah. How would you compare Caterpillar and Deere? I mean, Caterpillar 1 year is up about 67%, just coming off a high of 382. Some of your thoughts. How do you rate Caterpillar?
So Caterpillar, we have a hold currently. Now, we did enjoy a buy for quite some time through its incredible run. But at some point, we have to consider some of the macro risks. In the U.S., very strong performance for Caterpillar, really driven by that infrastructure activity. You have the reshoring trend that is in full swing, also supported by some legislative actions, though there is weakness in Europe for Caterpillar. Though I'd say a fair comparison for Deere would be their direct peers like CNH Industrial and AGCO, because really what's going to move the needle for Deere is those agricultural prices, which is it's not this same story with Caterpillar. And with that comparison, we like Deere better. We think it's a best-in-class company within the agricultural machinery space. It's historically been way ahead of the pack as far as profitability, technology stack. So even with the broader malaise in the economics of agricultural products, we still think that execution is going to be solid. And just to broaden that point, we do like Deere's strategy moving into the second half of the year. They're going to focus on underproducing relative to demand, get inventories nice and low. So 2025, they're staging for a recovery. So the idea is to take some of the pain up front the rest of this year. And 2025, we could start seeing a sales recovery and a recovery in earnings based on how they manage inventory over the next 2 quarters.
So is that going to be, I'm almost out of time, but just is that how they're going to have that rebound in 2025? Is it going to be managing inventories or maybe a better rate environment?
Yes. Two tailwinds there. If we do start seeing interest rates cut rather than say an increase from inflation not abating, affordability is going to improve as well as you mentioned, inventory levels are going to be managed quite well. If that is the case, which we're confident, then we could start seeing a more rosy picture moving into next year.
All right. Jonathan Secreta, equity research analyst at CFRA. Thank you so much. Great look there at Deere and Caterpillar. Thank you.